As investors, what we do is we're basically making money on the spread between the cap rate and the interest rate. So right now, cap rates are at 5.08% on average, and the 10-year treasury is at a 0.93. Investors make money on that spread, and then of course we apply leverage, good, healthy leverage on top of that to magnify those returns.
This is a story about a dude named Lane. Then one day he went to try to rent them out, and then he became one of the man.
All right, welcome everybody. This is going to be the March 2021 monthly market update. But before we get going through the content here, I had a lot of questions on some of the current events that have been taking place, especially in Texas out there where the temperatures got into the single digits there for a little bit. Yeah, we've got a lot of assets owned, maybe half a dozen apartments out there. And we just finally got chugged through most of the aftermath. And yeah, there are a lot of burst pipes and a lot of leaks, but everyone was freaking out. Yeah, we had some issues, called the plumber, and they got fixed. Damages on most of our apartments are 100 to 250 units, but the damages came back at maybe $5,000 to $20,000 per property, which seems like a heck of a lot of money. Hurt the monthly profits, but really not touching cash reserves. And yeah, it's a bummer it happened, but just got to think here for $5,000 to $20,000 on a lot of these properties where the monthly revenue is $100,000 to $200,000. If you just take $1,000 times 100, 200 units, 250 units, that's how we get 100 to 200 grand brought in. 5 to 20 grand is not that much money. It's probably about 10 to maybe 20% of that. And normally the net operating income, the profit that we bring in, is usually in the $50,000 to $100,000 range. We still made money, but I think those of you guys who are into the turnkey rentals, you guys probably understand with your turnkey rental, maybe you're bringing in $100 a month. That's a $100 to $200 repair bill on the same magnitude that we have. And I guess that's why we like the bigger assets, because on a lot of these, we did have one where the chiller got a little damaged, no big deal there, but for the most part, it's just a bunch of plumbing issues, which a lot of them got taken care of with in-house staff. That's the nice thing about with these bigger properties where we have a lot of the staff on call that we pay on salary, as opposed to paying those huge third-party repair bills. And that's what I never really liked about being an out-of-state remote landlord. I've paid like $900 to repair a stinking toilet. I don't know, at $100 to $200 hourly billable rate, that's a lot of hours to fix a toilet, in my opinion. But that's how it is as an out-of-state landlord. But yeah, you guys who are lower net worth, I'd say you still got to start there. That's where I started. But make sure you guys run your numbers right. If you guys haven't yet, grab a hold of my buy and hold analyzer. It's in Excel or Google Sheet format, full explanation of all the expenses to make your own pro forma. So in case the Texas freeze happens again, you'll be able to absorb it on your monthly cash. And like for us, it didn't really dip into cash reserves. And this is what allows you to perform your sensitivity analysis on your own. So to grab that, go to SimplePassiveCashflow.com/analyzer. Or we also put it on the SimplePassiveCashflow.com/turnkey page for folks to grab for free. But we'll get right into this month's report. If you haven't yet, please join our Facebook group and check us out. This is also recorded in podcast form on the podcast. And I also put the slides up on YouTube. So if you guys are listening on the podcast and you're feeling some FOMO for missing out on some of the slides, you can check it out there. For those who are joining live, feel free to put in a question into the box if there's a question that comes out. But we'll start off with a few teaching points here. I just grabbed this out of a Newmark report recently. And this models the interest rates, which all-time lows once again. Maybe it's been creeping up this first quarter, but still pretty much as low as it's ever been. And the cap rates on multifamily. And this is just a general cap rate for all markets, all asset classes. So the important thing, what I want to show here is everybody asks, when is it time to buy? It's always a good time to buy when you're cash flow. But as investors, what we do is we're basically making money on the spread between the cap rate and the interest rate. So right now, cap rates are at 5.08% on average, and the 10-year treasury is at a 0.93. Investors make money on that spread, and then of course we apply leverage, good, healthy leverage on top of that to magnify those returns. Look what's been happening these last few months. the spread between the cap rate and the interest rates is a lot bigger than normal. Some of the squeeze points at times where it wasn't a great place to be investing was mid 2018. As you can see by the chart, there was a bit of a squeeze there, or maybe in the between 2006 and 2007, there was also a squeeze there. But the times where the spread widens, now that's the time to invest, like mid 2012 here and right now. But that's your academic look of how investing works, essentially. And this is what a bank does. They go and invest and arbitrage the money somewhere else, and they take on debt, but good debt, to be able to hold on to the asset that cash flows. A lot of good news have been happening. I saw the last market update, Jim Rickards, John Burns, a lot of these guys are giving the green light. But I wanted to report on, as I mentioned in the previous slide, long-term interest rates have been creeping up just a tad this first quarter of the year. Now, 10 and 30-year Treasury yields have been running up the start of 2021. That's where we're conservatively using like a 3.5% as a placeholder for our commercial deals these days. I don't really know what people are getting for residential, maybe around 3%, but it's been creeping up lately. Now, just a little bit of, if you guys have been following the news, on January 4th, the yield on 10-year Treasury note was at 0.93, and the 30-year Treasury yield was 1.66. A month later, the 10-year Treasury came up to 1.19, and the 30-year Treasury came up to 1.96. Now, that's a big move for just a 5-week, 1-month period. Bonds have been getting killed in that interim. Now, what's driving these changes? The Democrats now hold the House of Representatives, the state, and the White House. And if you look back and how the stuff was moving when the Georgia Senate runoff was happening and tipped the scale to the Senate, going to the Democrats, the markets reacted by expecting massive fiscal stimulus, because typically the Democrats do spend more money. And the U.S. Treasury expected to bring massive amount of bonds to the market for a fairly short period of time. Now, what does this mean? I look at it, this is all good for investors like us, because ultimately more government spending means that it trickles to us landlords and investors. This is what is essentially driving up yields or the cap rates on the short term, because as I said in the previous slide, cap rates typically go up when interest rates go up. They float together. Investors make money on the difference between the cap rate and interest rate plus the leverage, which magnifies the difference. So in other words, sophisticated investors know that cap rates typically go up and down with interest rates. They don't really freak out when these types of movements happen. Now, the economy is continuing to reopen more and more, and I think Biden just released another stimulus plan to hopefully get a lot more people vaccinated by the end of April. So all good news pointing to a big recovery. And I've been seeing a lot of Fannie Mae, Freddie Mac reports. And we'll get into this later on in the report. But a lot of these guys are saying that Q3, Q4 GDP growth should be over 4 to 5%. Here is one of those reports right here from Fannie Mae. You look at 2021, they're predicting a 4.8% GDP growth in Q2, Q3 7.5, and Q4 6.1. So that's big stuff. Probably what that's accounting for is personal consumption expenditure is big in Q3 of 2020. A lot of people think inflation is coming. I don't necessarily agree that, even though logically that makes sense. I think they can just keep printing money. But even if inflation does happen, right, like by buying fixed commodities, hard assets like real estate, you're hedging that way. Facebook plans expansion to the Huntsville data center project. Price could top $1 billion of development. Ongoing construction. This is their construction in February 2021, and they announced this back in June 2018. So you can see how long these projects take to get in there. But Facebook is definitely committed, it seems to be by this picture, that they're going to put that big data center in Huntsville, Alabama. Here's another chart that I found from B of A Global Research, and it shows the different models of COVID cases coming down. And basically the news has been getting better and better. The Van Line report has been released, and it's very similar to the U-Haul report. The U-Haul report models, there's a great indicator for the blue-collar workers, the budget folks who have to move themselves, where the Van Lines is more your white-collar workers, where if you're a corporate worker, you have to get moved, relocated. The Van Line is typically who's going to move you. So the top 10 on the moving out list in this order was New Jersey, New York, Illinois, Connecticut, California, Kansas, North Dakota, Massachusetts, Ohio, and Maryland. Obviously, New Jersey, New York, California, everybody knows that at this point that everyone's getting the heck out of town. Illinois, if you haven't heard that, everybody's getting the heck out of Illinois. That state's going down really fast. What are the states moving in? It is Idaho, South Carolina, Oregon, South Dakota, Arizona, North Carolina, Tennessee, Alabama, Florida, Arkansas. And again, this is the more white collar worker folks. Freddie Mac flags robust growth in the South and West. So they cited 3 Texas cities grew by a combined total of 2.8 million people from 2010 to 2019. And I think we all know what they are. The Dallas, Houston, and Austin grew by 2.8 million people. Why? Lower cost of living, attractive weather, influx of domestic and international migrants. Howard Hughes, one of the biggest master plan community developers, is adding 2 million square feet of new development across 4 master plan communities in Las Vegas, Cypress, Texas, Columbia, Maryland, and Honolulu, Hawaii. It's always interesting to see what the big institutional money, these guys pour a lot of money into research, and because they're making big bets on whether they're building. Of course, we as more mom and pop investors be a little bit more nimble, but it's good to whale watch what these guys are up to. Another guy you want to definitely whale watch on a more macro sense is Sam Zell. If you don't know who that is, you better know who it is, because right below Warren Buffett, this guy is the guy who kind of picks certain sectors, not necessarily good management companies or like how Warren Buffett does, but Sam Zell definitely is a better picker of sectors, in my opinion. So his commentary is he expects a rebound for office, hospitality, and big city multifamily. Chicago, he's a native of Chicago. I guess he's not moving out. He has a lot of money. He doesn't care. But he doesn't, not so much by permanent shifts stemming from COVID-19 pandemic, office use, hospitality, and central city apartments will all rebound, while the industry icon sees potential for oversupply in a couple of certain currently hot sectors. It says, I think we're going to go back to conventions, back to people creating relationships. I don't see that changing, although it will restart slowly. There's also a huge buildup of tourism demand. People have been locked up for almost a year, which I would agree personally. I think you don't say it very much, but a lot of folks in this pandemic were hurt by the things being shut down. But a lot of white collar folks are just totally unimpacted, and they just got a few stimulus checks on top of that. So Arbor put out a few of these great charts that I put up on the screen, just modeled how did the COVID-19 recession relate to the Great Recession. So if you look here, the green line, basically, if I'm going to describe this for the folks listening on the podcast, aren't able to take a look at these charts, which, by the way, you guys can all look at these replays at SimplePassiveCashflow.com/investor letter, is where all these past monthly updates are held, in case you ever want to go back and spot check on something you saw. But the way that it's illustrated, and I think this makes a lot of logical sense, is the beginning of the pandemic was a big spike, big impact, where the other recessions, it took a long time, 12 months to develop, where this COVID-19 recession, in 1 month, unemployment just shot up. But then very quickly, I would say, just reading by this chart, 6 months later, things came down and has been steady on the decline. And on this chart right here, we're already under 5% unemployment, where all the dot-com, the Great Recession, the 1990 recession, it took 5 years to get to this, 5 years plus to get to this point where we're at now in terms of unemployment. So some would say the recession is over. I personally don't even call this a recession. It was just a health crisis. Consulting releases apartment rent forecasts, 4 big trends that they're seeing. First, the Bloombergs. Suburban apartments were the biggest beneficiaries of the 2020 pandemic, with renters looking for more space. Examples would be Austin, Tampa, Phoenix. Next is brain towns. These are the demanding college towns to improve in fall as students return to campus. More tertiary markets like Ann Arbor, Boulder, Colorado, Madison. Other beneficiaries are downtowns, which should come back into play, he's saying, by 2022. Work from home may have softened demand in urban markets for now, but watch for a bounce back in COVID. So they're citing Boston, DC, New York, Miami. And the dependable markets are historically stable and steady, They reforecast some bumps in the near term, but big opportunities long term, such as places like Minneapolis, Kansas City, and Reno. And from a real high level, what we look at a lot is just strictly population change from a high level. And here's a chart from Newmark illustrating where the population growth is. If you look at the tan areas, those are the areas where people are moving out. The blue, the darker blue areas where people are moving in. Now, this I stole from a 2021 Rockefeller Family Office report. A lot of things are going on in this chart, but I just put this in here to show folks that how the wealthy invest, right? They're not just in retail mutual funds and that type of stuff, but a lot of these guys are in that private equity space, which we really focus on in our group. That's what we kind of call ourselves, private equity. They are the Rockefeller guys. They're probably going to decrease their long-term U.S. treasuries and also decrease their high yield corporate. They're also going to go to more emerging markets and also decrease their U.S. large cap equities. But a big chunk of it is private equity. I think that's my other takeaway from that. And what do they mean by private real estate? Mobile home parks, apartments, office space, things like that. And just to take a little break there, in case you guys haven't noticed, we do have a mastermind group. If you are a accredited investor, please check us out, SimplePassiveCashflow.com/journey. And for those of you guys, I would say under $250,000, $500,000 net worth, and looking to buy your first remote investor incubator, you guys know that you guys have to get off the active train if you're flipping houses, wholesaling, and you got to get started. But how? You may not have enough money to do syndications quite yet. You may not be a sophisticated investor. So check out SimplePassiveCashflow.com/turnkey. Great way to get started. That's the free guide. But we are starting the incubator group, which is a 5-month boot camp where we walk you through buying your first rental property. And now we're going to go and to my personal report. I always like to split this off into different categories based on the Tony Robbins 6 human needs. More information about that, go to SimplePassiveCashflow.com/happy, because if not, what's it all for if you got all the money in the world if you're not happy? So the first one here is growth. No, I'm working on my last burr. I don't like burrs at all. I think it's too much risk. I think it is a real pain to do. I don't think it's a great return on time. But I think if you're lower net worth, I think that's where it kind of comes into play. Or in my case, I want to just unload these last 2 rental properties that I have. So I am actually, I think I put in maybe like 20 or 30 grand into this property. And yeah, we hope to sell it quick, unload it to some retail and buyers, and wipe my hands with this direct ownership stuff, unloading the rentals. Woohoo. Contribution. Well, the family office Ohana Mastermind has been having a lot more new recruits into our group. I really enjoy helping out the people there. I don't have the time to individually help out folks just in the general HUI Pipeline Club anymore. Now that we're over 400, I'm getting over maybe 500 investors now who've invested at least 50 grand into a past deal. If you guys want family office consulting, you probably can't afford that unless you're $100 million net worth and above. So that's where our family office Ohana Mastermind. It's a group coaching experience. But significance, how to get significance? I couldn't think of anything, so I just told myself the old stoic line, no one cares, work harder. But number 4 here, uncertainty. The Texas freeze was a bit of uncertainty into my life this week. Who would have thought, right? Thank goodness some of these places had natural gas. But yeah, I don't know. Maybe I wasn't reading the headlines too much, but some people seem to be really freaked out and they thought there was some kind of like with the whole energy crisis in Texas. And a lot of our properties is business as usual a couple of days later. But yeah, there's always going to be something that makes people scared and stick to the status quo. If you stay with the status quo, we all know what we're going to get. How did I establish some certainty in my life? That was the report from Hawaii. At the same time, light forecasts of light winds, some more showers as the cold front nears. We actually got into the high 70s. Had to grab a jacket. But in all seriousness, Charlie Munger, he was Warren Buffett's buddy at Berkshire Hathaway. He always has this famous rule, and he was recently on the news the other day. They asked him, well, what's the rule for a happy life? And he says, low expectations. And as I look at my investor group, a lot of you guys are very value-driven folks. A lot of first generation, or actually most first generation people that value things and experiences and what the value of the dollar is. And you guys can keep it simple. Sometimes too simple. I think a lot of you guys can be a little bit too frugal at some times. Some loving connection. Well, we're expecting. I am no longer going to be working 12 hours every single day. Hopefully, if everything pans out, I'll be a dad in January. But thank you for all the words of encouragement on my Facebook and LinkedIn. I'm actually going to compile, going to have my assistant get all the best practices that you guys put on there. A lot of you guys put good tips on my feed. So I'm going to compile that, put it all in a spreadsheet, categorize it. And those of you guys who commented, I'm going to give you guys access to that spreadsheet so that you guys can share it with any friends or family that you guys have. I think that's something I've learned from this investing thing. Everything is out there. We just have to tap it all. And there has to be at least somebody, and I guess that's the role I like to play, that facilitates the conversations or captures everything in a digestible form. If not, there's just a lot of noise out there. There's just a lot of like big pockets and stuff like that of just endless data and knowledge out there. Some fun things I bought. These are doodads. I bought this fried garlic chips from Amazon. It's like pretty cheap. It's like $15 for a pound. And what's cool about this is I set this up on subscription. So every like 4 to 6 months, it sends me a new one. But I was trying to find a way. I like those garlic chips to fry, but unless you fry it perfectly, it doesn't get burned or it gets moldy after a while. So if you guys like thinking the same way and you guys like to cook, try that out. And I thought I'd splurge from the old Heinz ketchup and get me some Portland ketchup here. Reminds me of my days in the Northwest where we would spend way too much money for GMO-free and gluten-free, vegan-free, and organic, by the way. But yeah, nothing in this presentation was considered legal or think for yourself, guys. Just think for yourselves. Thank you, everybody. And if you guys haven't, make sure you sign up for the HUI Deal Pipeline Club to get sent the same deals I come across. The HUI Deal Pipeline Club is a free investor club where I filter investments and underwrite the deals and partners, and a lot of times operate it myself. Unlike in other investor lists and groups, my investors know I kind of personal skin in the game. If you would like to join, go to SimplePassiveCashflow.com/club, and we'll see you guys next time.
This website offers very general information concerning real estate for investment purposes. Every investor situation is unique. Always seek the services of licensed third-party appraisers and inspectors to verify the value and condition of any property you intend to purchase. Use the services of professional title and escrow companies and licensed tax, investment, and or legal advisor before relying on any information contained herein. Information is not guaranteed, as in every investment there is risk. The content found here is just my opinion, and things change, and I reserve the right to change my mind. Above all else, do your own analysis and think for yourself, because in the end, you are the only person who is going to look out for your best interests.